we're not so politically driven, and every president is a good president, in my opinion, but their tax stuff. And, I could have Biden's tax stuff come out. Some of them, I'm just like, that is so wrong for the small business. But some of them you think, okay, that makes sense. So I think really, it doesn't really matter what new tax coming out. And the key is really about planning. Don't you agree? It is about you. It's almost like you're born into a household. You can't choose your parent. And we step into this time of life, and this president or last one, and whatever they provided to the economy, it is in their opinion, they think that would help. So they come up with a bunch of new things. Now we just need to really know what they are, how they apply to us. And a lot of those Googles you do, if you search for new tax code or new tax legislations and for yourself, I'll tell you that is so confusing, and don't go there. And in our business, and we, of course, Community CPA, we're here for, 25 years and 2.5 decades. So we have accumulated the kind of knowledge that is really particular to our kind of people. So if you are a business owner, startup, brand new, and or you're a successful business owner running your annual sales like between 1 million to 100 million, you are our client. So we know these type of people. And I don't know anybody like Bill Gates. They're not my client. And I don't know how they spend their money. And Donald Trump, so how, he only pays $700 taxes. Don't really know about what they are doing. But if you are in this area of status for business, your annual sales is under 100 million, and you are starting up your business, you're at the right place. And communitycpa.com, it is your right website to log in to see what we have, and go onto our YouTube channel, right? And really tune in our YouTube channel and see what's new. And what I bring you today is nothing fancy. I'm going to give you what you need to know, because anything beyond generation tax and all of these sophisticated rich people area of change, we don't talk about that because we're not that rich, and I'm not going to reach that situation very quickly in my lifetime. So I just care about what applies to me, right? Applies to my situation, what applies to my clients' situation. So I have all of you here, and I am going to go through that and then make you share what I understood. And no responsibility disclaimer, folks, ladies and gentlemen, and please take your information carefully and with a judgment, right? With a grain of salt. That is a judgment to see how salty the dishes would be. So, all right, big picture. I love to give big picture first before I dive in, because if I don't do that, many people like me, I did not grow up in US, and I didn't even go to US school, okay? I did my school in Canada, and so I didn't learn the legislation process and all of these, and I just learned it by, have to know it because of the taxes. So here this year, and in May, we have this President Biden's budget request, okay, remember? So he requested this budget. And then in the budget, of course, the new president come on board. The budget is really about his agenda. He wants to accomplish something. So he wants to spend on certain programs and to level the playing field and they call that a fairness in taxation. So he has an agenda. That agenda is reflected on how much he wants to spend and what he is going to spend on. And whether with the budget, if it is negative, and how to make tax to work for him so that the negative can be shrinked, right? And we don't have so much negative. The Congress, after the president give a proposal, the Congress goes into working. and the Congress will advance the president's agenda. That means whatever the president trying to accomplish, that is Congress goal. That is the resolution. It's almost like, you know, making it becoming real, right? Not just president's thinking anymore. And it's going to be a real rule and regulation and the tax act, and everything is being enacted, becoming an action for everyone, for the whole country. So the number one, and there are three things I want to mention: corporation and international tax reform, and increasing tax for high income individual, and improve and enhance IRS tax enhancement. And I will say that these three are very consistent. There's not much of an argument about that. It is, you know, just maybe how much of a rate that would be is an argument, but to come out as a real act and is there. So folks, I want our small business owners, you are listening to me right now, folks. And if your sales is between 1 million to 100 million a year, you are the one should listen to me. And I'll tell you that the IRS tax enforcement, it is a one big agenda in there. What does that mean? That means the president want to give more money to IRS. So IRS would hire more auditors. Then the more auditors would take care of lesser account, right? Because if they're so busy, they can't really audit very effectively. So if you give them money and they start to audit you, they have time, then they can get more revenue. And I looked at that. I actually couldn't remember. I think it was 10, I don't remember. It was either 70 billion or 170 billion. It is budgeted for IRS to audit taxpayer to get paid, to get more money back. So I want to say this to you because I want to lay an environment for you. Okay, so now pandemic is kind of in the rear mirror. We're kind of come out of it. Hopefully we did. And then the next thing you see, it is going to be government enhancement, not just IRS, SBA, DOL, and the business owners. This is a wake-up call for you, and you got to do things correctly. You have to. You can't survive, okay, if you don't. So now, let's see if these new rules come out and the new tax rules come out. When is it effective? I get this question from everyone every day. And then the business people, our client come and we're talking about 2020 taxes and we just kind of done with that. And then obviously people are worried about 2021. So what is going to be 2021? Are they changing it or no, they're not changing it? Are we still going with, Job Act from Trump's time, or things are changing? So very complex. But one thing I want you to remember, in general, historically, the changes to the tax rule would come into play in the beginning of the year, which is, let's say we put that in act right now, then the effective date could be January the 1st, 2022. Okay, but here, certain provision may have proposed effective dates tied to the date of announcement, committee action, or enactment. So for example, capital gain tax. Capital gain tax rate is going up. And that right now, the president was saying that let it happen on the day we announced it. It's April 2021. So that means if you sold your property after April 2021, I am sorry, your capital gain might just go up. It is no longer the same. And of course, the House also proposed, the House proposal is start on September 13th. It is all the days that is already passed. What that means to us is, if you want to come to Ying, do a tax planning, saying that, whoa, let's just sell this property because I don't want to pay a lot of capital gain on that. Too late and so sad, because those days is already passed. You can't really sell anything right now and to not pay the new tax rate, right? So those are examples I give you. So in this whole package, there will be here and there certain items might have a different effective date, but generally speaking, should be January the 1st, 2022. All right, so the next one I want to talk about is this pass-through deduction limitation. That really affects everybody who are small business owners. So a lot of us, a lot of small business owners are using this pass-through entities, 1065 and 1120S, right? This one, you know that, the K1 stuff, right? So now, in the past, so this is the President Trump passed this Job Act, and this is what one of his doing. So it's called Section 199A pass-through deduction. So what happened is, let's say if you have a K1 and from your, you and your brother are in the partnership, you have a K1 from the partnership, and it was $100,000 income. And right now, in 2020, when I did your tax return, I actually only made you pay taxes on the $80,000 because there is a 1099A pass-through deduction, and I made it for you already. I reduced your income from $100,000 to $80,000. So that is what we call the pass-through deduction, 20%. Okay, and now the House Ways and Means Committee, and the one that who is trying to push through the agenda, for have the Congress basically working with both House and Senate. So the House proposed that the Section 199A, the 20% pass-through will be limited to your income level. So let's say you are a small business, okay? You are so afraid of not making it, so you're still working on a full-time job. You are still working at Wells Fargo, and you got paid, say, $400,000. I'm just making it up. I know people who get paid $400,000, but let's say you got paid $400,000, but you're doing online selling and you make money, and your K1 is $100,000. Okay, because you made more than $400,000 as an individual, and that 20% of deduction, the $20,000 that I normally would give you, is no longer there. That's the proposal. Proposal basically says that if you are regarded as making too much money and a wealthy individual, and they don't give you that 1099A pass-through deduction anymore. So I had an example right down there for you. For example, if your W-2 income is 300K and your pass-through income is 150K, so let's say that pass-through is from your, your internet sale at night. Your W-2 is from Wells Fargo for your salary, and normally you would get a 30K deduction on 1099A. That would save you $8,400 in income tax. So that is 150K times 20%. That's the 30K. 30K deduction out of your income, that saves you $8,400 taxes based on your income level. So now this new act, this new thing that President Biden proposes, Congress is trying to enact it into law. And then this one will say that, you know what, you made a little too much money in our consideration to do this fair taxation thing with you, and we're gonna make you pay your $8,400. So, you don't get that deduction. That's basically what they're doing. So how did that relate it to you? So related to you. This is why I say that our webinar has no bogus stuff. And we don't, I'm really, English is my second language. And I am actually really not good at doing small talks. And when I say things, I tend to get to the point. But in order me, to have that ability to get to the point, then I need to know my stuff. Otherwise, I don't know how, I don't have the fancy ways to make my talk amazing and then not telling you anything. But there's so many people on the internet, their talk is so amazing, but after I hear it, it's like I got a zero, nothing. I don't even know what they were talking about. I was simply enjoying the sound of the words. you know? So, but in this webinar, I want you to take home, I want you to know what you are facing. If you get K1 from your business, yes, that's your issue, okay? You need to think about it. Now, more. So let me ask you, there are, we have quite a few encounters with our client, and 2020 is such a scary year. They lost a lot of money in 2020. So while we were doing 2020 business return, there's no limitation on the loss. So let's say you have the client has a S corporation and lost 500,000 in 1 year. Sure, they didn't even open for half of the year and lost 500,000. It's really not that strange. So, but this 500,000, it went into their 1040, right? So let's say if they don't have enough income to offset, it's become a net operating loss or net AGI. So they actually, let's say they have a W-2 for 100,000, you pass on to $5,000 losses. So they have a loss of 400,000. Am I right? That 400,000 can go back to 2015, 2016 to offset the taxes they paid, to offset the income they made in 15, 16, 17, 18, 19. Until zero. So all of the taxes they paid for the 5 years is coming back to them. This is the retroactive getting back your tax dollars. That is the CARES Act. Okay, so that is the one that gives you that access. So now this new Biden's proposal is eliminating that, saying that no, we don't want this kind of excessive deduction. We want to limit that. We want to limit your deduction. So that's the core. That's what they're doing. So in terms of how to limit that, I haven't really seen anything in specific. Could easily be just eliminating. You can't claim. And when you have excessive loss, you have to wait until you have a gain to offset. You cannot offset your income right now. You can offset the same kind of income, wait until your business make money. You can reverse it, but you cannot deduct it right here, right now, or going back, right? So that is a thing. But again, 2020 is actually the most significant year. A lot of businesses going through that. 2021 maybe is another year, because I have heard not once, not twice, many times, the business owner were telling me that 2020 is hard, but it's hard all over. It is hard without choice because of the pandemic. But 2021 is harder. It's harder because people are getting tired of the pandemic. So mentalities are changing. And there's people are rather stay on unemployment benefit than working. So the workforce is an issue. We have such a poor employment rate right now. People just willingly, happily, satisfactorily wanting to be unemployed. Okay, that is not something the business owner or the economy is expecting, but that's what we are facing. Okay, so with that, there are losses. Their restaurants don't open because they can't find workers. So because of that, our business owner will still have a loss. So is your 2021 loss going to be eliminated and put down, delayed, or you can still do what you have done in 2020? That is an answer I don't have right now for you. But that is a decision they're making at Congress. So that is important to you. Am I right? So far, those items I brought to you, they're important. Let's look at more. So this 1202 is related to qualified small business stock. Okay, I know it is a lot of terminology here, but let me just give you the simple, really simple analogy, like give you a real example. So we have a client who had 10 years ago, she just need to be 5 years ago, but 10 years ago, she invested in this small corporation. So in this year, 2021, she wants to sell it. She wants to sell the company and that be done. So she is selling what we call qualified small business stock. So she qualifies because, you know, there's a definition of how do you qualify, whether the small business is qualified small business, and most of the people who listen to me, you qualify. Let's just put it this way. And if you are a stock owner and you obviously and would look at this section 1202 goes, what's that? Okay, what's that? That is when you sell your shares in the S corporation, you bought it for $1, but when they sell the company, they probably paid you $1 million, for example. Then you had $999,999 capital gain. That gain is 1202. And if your income is at a certain level, that gain, you can reduce your gain to 50%, 100%. So there is a reduction for the gain, exemption for the gain. That is existing rules here. You know, I know you don't come across that every day, but this is something I want you to know. Okay, when you sell your S corporation shares, you might be this. When you sell your C corporation shares, you might be this. So that gain, you can have exemption. But what the proposal here goes that, no, they don't want to have this blanket exemption. They want to say that if you are making too much money in your business or on your own, and you don't qualify for that, they don't want to give you this. They want to reduce it further. So this is the consideration. They're trying to appeal that section 1202, which is in place today. Okay, so you know the reason it was in place is because the venture capital, you know, the equity partners that small business would get, they would be interested in that. And they would be more willing to invest in your company. So for example, a venture capital could invest in your company because they know that they would have this capital gain in the future for free, right? So those are every section of tax code would derive some sort of benefit to one person or another. So it is this rule right here that they're looking at to repeal. So I want to just embed that in your mind to tell you that, you know, you have a chance to pay less taxes when you sell your shares as a qualified small business stock. And don't just treat yourselves like nothing happened, didn't even understand what is section 1202. I just need you to remember there is a thing in the tax code. It used to allow some deduction. What is the new things now? Ask that question would prompt a research, would give you the right treatment. Okay, so obviously these are not set in stone. We don't know what yet to happen, but it is on the table to be digested. All right, now this is a biggie too. Man, okay. So do you remember when we had Obamacare and the President Obama enacted this 3.8% net investment taxes to tax the rich, to say that if you have non-business related income so much and pay 3.8% more, because this 3.8%, it's called the net investment taxes out there, but in the document, like at the time, it was actually called unearned income Medicare contribution tax. It is a tax that to supplement for Obamacare. Okay, so that has been in place for a while, folks, because that was from President Obama time, right? So now what Biden administration want to do is they want to expand that. They're saying that, oh no, don't do it just for unearned income. Let's do it to the pass-through income, the business income as well. So as corporation owners, the one with K1, and the partnership owners, the one with K1, and your money coming in, it is going to be taxed for 3.8%. That's the proposal. Okay, so the House proposed to apply only to the pass-through business with income greater than 500,000 as joint and the 400 as a single. Okay, but I want you to know that this 500, 400 doesn't mean like it is from other places. So if you pass through a 600,000 income, you already over the 500. So you would apply to that 3.5, right? 3.8. So see, the House is saying that, okay, let's do that to the richer people. And the Biden's original proposal that rolled out in May, like when he came out, that was on everybody, on everything. Proposed that those making over 400, okay. So, my note says that Biden proposed on over 400 and their partnership income and S corporate income was subject to employment taxes. Yes. So this is what he proposed. You remember like people who has a K1 from S corp, they don't pay self-employment tax when you pass on the K1 income to the 1040 tax form. You remember that, right? My small business owners, you know what I'm talking about, right? So Biden's proposal back in May was saying that let's do self-employment tax on that too. If that goes through, it would make no sense, absolutely no sense. Why we even care about reasonable pay? Why we even care about having an S corporation? Because you're literally running as a sole proprietorship, if that's the case. Okay, so House proposed saying that, the House proposed to apply only this 3.8 to all net income from pass-through business for taxpayer with income greater. So they're not saying the 15.2%. Because Biden's proposal is an employment tax, that's a 15.2%. So now the House goes 3.8, and the House proposed effective date for this is beginning and after this year. So that means it will start January the 1st, 2022. Okay, we're already in 2021. So they're not starting that now, they're starting next year. Of course, whatever House, whatever I put in here, it didn't becoming law yet because Senate still have to approve, then they have to do this budget reconciliation. So we are still in this pausing or working period, and so there's not final, right? So don't go out of this webinar felt hopeless. I mean, it is not final, but the stuff I pull out here for you folks, it is going to come out in one way or another, and we will just have to see how that impacts you. It is a lot of stuff, and I mean, when I guess President Trump did similar thing, but I didn't feel it was as heavy as this one. So now, another one. It's also related to you so closely because when you come to do taxes with our firm, and so many of you were like, oh, Ying, I paid state taxes for 45,000. What are you talking about? I can only deduct 10. What about my property tax? My property tax is already 15,000. What do you mean by only deduct 10? What do I mean by that is President Trump did something through the Job Act. And he lives in Florida. He doesn't care because he doesn't really pay state taxes. And he didn't like a lot of the states with charging taxes. So he's like, no, I don't want you to deduct it. So he wiped it out and leave only $10,000 for people, right? So the House proposed to, so far, do not include any specific relief regarding the 10,000 on the deduction. So what that means, the House proposal right now, it is out on the internet. and it didn't really do any change. It still kind of left it that way. We still couldn't really deduct state taxes. I really want that state taxes to be deducted because we live in Iowa, right? I live in Iowa. I'm a resident of Iowa, so I pay taxes to Iowa, and that taxes I pay, and the plus property tax I pay, I can only deduct 10,000. Just pathetic. So, but house didn't do anything. But the house, this guy's name, Richard Need is the chair for the Ways and Means Committee. And he said and he will include some meaningful relief in the final package. So they're not final yet, but when they do, it will. So that meaningful relief, perhaps to increase that 10,000 to 40,000. That's better than nothing, folks. Everybody who are here on my webinar, if you live in the state that you pay state taxes, and this is good for us. Hopefully they pull something out, right? All right, what else? I know this is the one that you're gonna tell me, no, Ying, I don't care about this. No, you do, okay? Our small business owners, we tend not to think of this. We never think we're gonna die, you know? We think we're just gonna live forever and we're gonna be so active and doing business, never stop. And I know what you're thinking, okay? And you, by the way, you are crazy, okay? So you're just as crazy as I am, and it's okay. That's why we get along. That's why you come here, right? So, but let's just put it this way. And I want you to know what we have right now. And just in case you happen to have time today or tomorrow to think about if you die, what's gonna happen. And it just, you know, I made it really simple. It is not hard to know. Right now, temporarily up to 2025. So we're in 2021, right? So 4 years. If you can plan right now, if you can plan to die within these years, and the estate and the lifetime gift tax exemption is 11.7 million per person, 23.4 per married couple. What does that mean? That means if you have property, money, and everything, after you die, you left on earth for 11.7 million. That means you don't need to pay estate tax. That's 40%, okay? So that is if you die right now, or if we don't change the rule, you die before 2025 and you would have that. And also on top of that, there is a 15,000 per child gift tax exclusion, 30,000 per child if the spouse go along with you, right? So I say per child is actually per donee, like, you know, the person you give money to is a 15,000. Most of the people, you know, my client, I see most of them are with children, not really with other people. So that is a 15,000 per year thing, 40%, right? Biden's proposal is to increase the 40% higher, okay? And also charge the step up in value. This is a concept that I really want to explain a little bit. When you die or I die, so let's say I have a property I bought for $100 when I live, and I die. That property, I didn't have time to sell it. I didn't use it. So let's say after I die and you sell the property, say you're my child, you sold that property and it is $1 million. Okay, so that means $1 million is actually relatively the market value, right? So it is called a step up in value, which is non-taxable. So my child will have that piece of land, not $100 anymore, it's $1 million. So if my child sell the land to another person for $2 million or for $1 million, my child don't pay taxes. Does that make sense? So that is what is the step up in value. Look at this one. The tax basis in inherited asset is stepped up to fair market value upon death of the descendant. Okay, Biden wants to change that. Biden said, well, and let's charge some capital gains on that. So it says that transfer and the death, the comment on the Biden proposal estate tax rate should be increased and the capital gain should be recognized upon transfer and the death. Look at that. Major departure of the law from right now, which is enacted by President Trump. But that is how Biden administration is calculating, and how the baby boomer generation, the elderly, and after they pass, if they enact this law and charging more, that helps with a budget deficit, right? So I just want our small business owners, and especially most of my clients are, a little younger than baby boomer kind of generation. And I know you have a long way to go. You don't plan to die, but to know what's going on, maybe, who knows, maybe you have a power to select when you want to die, and then you die in the time the estate taxes and the step up in value is the most favorable. I am just kidding. Of course, cannot, right? But, just something that I know it is important for some of my older clients who are in business. Now, this is also related to our small business people. And I know you have those moments. Your employee were asking, hey, do we have retirement plan? I know you may say, no, we don't have. And the proposal is here, okay? The House draft legislation was voted past on May 5th and aim to increase retirement savings, simplify retirement plan with changes. So their goal is to have a retirement plan more available, easily implemented, and do everything they can to increase the saving. The new legislature requires, okay, this is like the plan, the proposal, okay? And they're proposing for automatic enrollment for 401k, and the 403p is another retirement plan, simple 401k plan. So automatic enrollment, it just means that when the condition met, you cannot say no. You just have to be enrolled. And this is for employer, okay? We're talking about business owners. And starting in 2023, we're in 2021. So 2 years, the employer with 5 or more employees would be required to offer their employee either IRAs or 401k type of retirement plan. You are required. If you only have 1 employee today, 5 years later, you're gonna have, 2 years later, you're gonna have more than 5 employees. And you know that on your agenda to accomplish your good business process, you need to budget for 401k because it's required. Reducing the waiting time before plans are required to allow long-term part-time worker into 401k from 3 consecutive years of service to 2. So those 401k plan, most of the employer, I know, it's 12 months. You work 12 months in the company, you get in. But the law requires that for longer time, 12 months is really a bonus, and you can take longer for them to qualify. But the new rule goes that they don't want to have people wait for so long. They started to talking about part-time people to qualify for 401k plan. So it is a movement to make that kind of like a cup of tea for every business. So, more and more business will be required to offer that. And of course, company that fails to offer that, fails to do the new legislation, face a excess tax of $10 per employee per day. That's $3,650 charge on every employee every year. When you can implement, you don't. When they qualify, you don't offer, and that is the charge for you. okay? And it requires qualified plan to designate catch-up contribution and Roth contributions. So that what that means is, for example, if I am older, I allow certain amount to catch up, right? That catch-up amount, and normally it is a pre-tax deduction and added into the plan. What it says here is that it will treat it as a taxable upfront, but become a Roth contribution. Not a bad idea. I think that would be interesting. It's just much more administrative work to do for those trustees and for the employers. And allowing plans to treat student loan payment as elective deferrals. That's a kind of form, but what it says is you don't have to pay your student loan with after-tax money, and your employer can treat that as if you put that money in your 401k plan, so it's a pre-tax dollars. Okay, and the increased catch-up contribution limit for individual age 62, 64 from 6,500 to 10, okay? And if you are older, for the non-simple plan, from 3,000 to 5,000. So really, first, that's for non-simple plan, and simple plan, 3,000 to 5,000. So like 401k in my firm, then if someone is at age 62 to 64, and we can increase, they can do catch up for 6,500 to 10,000, from that to 10,000. You know, people are already doing that. Right now, it starts from age 50, right? So they're just saying that you can even do more. You don't have to do 6,500 in age 50. So from 50 to 62, you do 6,500. But from 62 to 64, you can do 10. So those are good measures. Really, what they're trying to do is just put money in the retirement, encouraging saving, encouraging people to accumulate wealth, right? How the act affects small business, okay? There are many tax changes I did not mention in today's webinar. Okay, I only addressed the one that I knew it is very practical for my clientele situation, because I know you guys and I know what you would ask. So if you have a business from 1 million to 100 million, and in every year sales, you are actually really in the right place to capture what is needed to know in this particular development on the new tax code, new tax laws, okay? And tax planning for 2021 is really important, folks. And I literally know that some of our clients, we have been tax planning for years. Like they always did tax planning every year around this time, but our legislation is not finalized. So a lot of those things we know, but we couldn't really put that into mathematical formula. It is not really ready for us yet. So, but you want to watch what is changing and follow our webinar. That's actually one of the big things you can do. And you go onto YouTube channel. If you just type in Community CPA, you will find us. And we have like over 500 videos there. You can search by topic. If you think of tax planning, you can type in tax planning, then all the video titles with tax planning will come up for you, right? That's one way to follow us. Or you just sign up, and you know, every Saturday 3 p.m. is generally my time, and I do my homework to come online to give you at least a good thoughts, and you don't have to learn anything, but some awareness for what's going on, right? And if you do tax planning with us, then I would recommend you to actually call in early, schedule the time. I know we don't know when the legislation will really final. We don't know whether the budget reconciliation would even come to fruition, and how hopefully they don't shut down, but eventually it will come. So whenever that become more certain, and our tax planning will start because we really want to know and what kind of impact we have in 2021, because 2022 things are not the same, right? Most of them will begin in 2022. Remember in my first slide, in terms of when those things start, that is your number one. That is your general starting time, number 1 point. So all of these new things should start on January the 1st, 2022. But some item like capital gain, there's already talk about enact that early. So people who sold places after September, maybe already too late. So we'll see. And like I said, book your appointment early. And this is how you reach us. And obviously you can go onto our website, right? And on our website, you can see the webinar and you can email Catherine, and she's really good at making sure you are cared when you come to our system. So that is my Saturday, 3 p.m. today. I hope you enjoyed it, and give me a thumb up if you like my video. And it is also streaming live on Facebook. So I would love to see a good response and giving me that energy to continue provide you with useful information. And I will see you again on my webinar site. Bye-bye.